Investing in the stock market can be a challenging experience for most investors. While investing is typically financially rewarding, there are some behavioral biases that can lead to suboptimal outcomes. In addition, the stock market can be an emotional roller coaster that causes anxiety. In this video, we'll discuss some of the most common behavioral and emotional pitfalls, how to identify them, and how to address them so that you can stay on track to achieve your investment goals. The stock market is inherently risky. It is made up of millions of investors trying to determine the right value for a company minute by minute. Imagine going back in time to a street market and finding merchants and customers engaging in negotiations to arrive at an agreeable price. If those prices going back and forth are displayed on a screen, it'll probably look a lot similar to what you see in the stock market. The price fluctuations reflect the supply and demand for publicly traded companies. However, these fluctuations can trigger emotions that lead to poor investment decisions. In addition, these emotional investment decisions typically occur in the most inopportune time, when most investors are also panicking and making quick, short-term decisions. It is during these volatile times that maintaining objectivity and the long-term perspective, as we've discussed in prior videos, is most needed. To help maintain objectivity, it is useful to understand the most common emotional or thought biases that impact our thinking. Loss aversion is a bias in which people tend to strongly prefer avoiding losses as opposed to achieving gain. Studies have shown that individuals tend to feel more negative emotion with a loss than a positive emotion with an equal amount of gain. This behavior typically leads to a few different outcomes. People holding on to their losing investments, even if it has little or no chance of going back up. Conversely, it also leads to selling a winning investment too quickly due to fears that their profit will erode. Oftentimes, investors sell too soon and miss achieving a better return. It can also lead to risk avoidance when evaluating a potential investment gain. And finally, it can mean holding a riskier portfolio than realized due to holding on to losing investments and selling winners too quickly. To assess whether you may have a loss aversion tendency, ask yourself what you would do if an investment you made dropped 25% and it was unclear if the company would be able to get back on track. Would you hold on to it or find a new investment opportunity? If you find yourself wanting to hold on to the investment, take a step back from the emotion and reanalyze the company as if you hadn't invested in the first place. Would you invest in the company now that has dropped 25%? Does the risk-reward look favorable? Asking yourself these questions may help in keeping your decision-making objective. Overconfidence bias is a bias in which an investor overestimates their knowledge and predictive abilities. Consequences of overconfidence typically lead to underestimating risks and overestimating future returns, holding poorly diversified portfolios, trading excessively, and finally, generating lower returns than the market. To identify whether you have overconfident bias, review your trading records and your winning and losing investments. Compare your returns to the market for various time periods. If you find that you might be overconfident, it might be useful to conduct more research on your investment before making decisions or getting opinions from other investors. The status quo bias is when an investor makes no changes. Some people are more comfortable keeping things the same and as a result fail to find better opportunities. This results in a portfolio that may be inappropriate for your return goals and risk tolerance. To address this bias, set reminders to review your portfolio periodically to ensure that the asset allocation, as well as the securities, are still appropriate. Regret aversion bias is an emotional bias that is similar to the status quo in that investors avoid making investment decisions. The difference, however, is that the investor does not make changes because they are afraid of their investment decision will result in a poor outcome. For example, an investor may hold on to a position because they are worried the position will increase in value and then regret the sale. Conversely, they may avoid purchasing due to fears that the value will drop. Thus, no action becomes the preferred decision. Regret aversion can lead to an investor being too conservative out of fear of making a bad decision, which leads to lower portfolio returns than the return objectives. It can also lead to a more risky portfolio as they make decisions based on what other investors are doing, or herding behavior, because it makes them feel better about their decisions. In overcoming regret aversion, education will be a key factor, as well as maintaining a long-term objective. It's also important to know that losses will happen to everyone, and that it's okay to have these from time to time. The endowment bias is an emotional bias in which people believe an asset they own is worth more than the value that they would actually pay. There could be situations in which they've owned an asset for a long period of time and struggle with an idea of selling it. As a result, an investor with an endowment bias may hold on to assets that are inappropriate for the portfolio. Another possibility is that the investor maintains significant exposure to one investment and, as a result, a poorly diversified portfolio with greater risk. One way to detect endowment bias is to think of the investment value in cash and think about how you would invest that cash. More likely than not, it will be a different investment than what is currently owned. Behavioral biases cannot be avoided. However, to help navigate the emotional challenges of investing in the stock market, it's essential for investors to develop a disciplined and rational approach.